Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at stock.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our analysis. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. When we start to look at this company, I think the first thing you have to realize is that, well, it's not your typical e-commerce player. Not at all.
Right. It's playing in a totally different league.
Exactly. We're talking about a hypergrowth machine, and that's really where the story has to start with the fundamentals.
And when you say scale, let's put some numbers on that. Because the figures they're posting they're genuinely industry leading.
They are. If you just look at the trailing 12 months, so as of Q3 2025, the revenue is nearly $58.79 billion US dollars.
That's a staggering number.
It is, but it's the momentum behind it that's just explosive. That figure is a 59% increase year over year.
59%. On a base that large.
Yeah. I mean, think about that. Growing at that clip when you're already at a nearly $60 billion run rate.
Yeah.
It's just exceptional. You don't see that from most of the major players right now.
So where's all of this acceleration coming from? It can't be just one thing.
No, it's not. It's a very strategic two-pronged attack. The most visible part, of course, is the international expansion.
Temu.
It's just blistering growth, grabbing market share everywhere.
But that can't be the whole story because that's expensive.
Exactly, and that's the second prong. The backbone of the whole thing is the resilience of their domestic platform, Pinduoduo.
Okay.
It's still performing incredibly well, and that provides the financial stability, the cash, to fund that global rollout.
So they're using their domestic strength to fuel the global ambition.
Perfectly put. And it's not just about revenue. The really remarkable thing is that they're improving profitability at the same time.
Right. Net income soared, what was it, 87%?
87% year over year, hitting over 14 billion US dollars. That combination of revenue and profit growth, it shows real operational discipline.
And that discipline shows up in the margins, I guess?
It does. The most fascinating thing in that Q3 report, for me, was EBIT.
Earnings before interest and taxes.
Right. Despite pouring all this money into Temu, their Q3 EBIT actually rose 3% year over year.
Which doesn't sound like a huge number, but why is that so important?
Because it's a huge inflection point. They actually had a decline in EBIT in Q2, which made the market very nervous.
Worried about runaway spending.
Exactly. So this rebound shows that their efforts to streamline, to optimize, it's all starting to bear fruit. They're managing a very, very difficult high-wire act.
Okay, so that brings us to the competitive advantage, the moat, as they say. How are they protecting this position from the giants?
Well, it's multi-layered. Domestically, they're already the second largest retail platform in China. That gives you scale nobody can really touch.
But the global story, with Temu, that's different.
It is. And that's where the real innovation is. It's their unique operational blueprint.
So walk us through that. What exactly is this direct-to-consumer consignment model?
Think of it like this. In traditional e-commerce, the merchant manages everything, right?
Inventory, logistics, pricing, all of it.
Right. Temu basically steps in and takes control of the whole chain.
From the factory.
From the factory floor right to the customer's door. The factory provides the goods on consignment, but Temu handles the warehousing, the marketing, and crucially, the pricing.
So you're cutting out that entire layer of distributors and middlemen.
Precisely. And that just crushes the supply chain friction, is how they deliver that industry-beating pricing. That's the moat. Nobody can match that cross-border efficiency at that low a cost.
It's the ultimate low-cost strategy, and they pair it with things like group purchasing to make the platform sticky.
Incredibly sticky. And they have the financial ammunition to back it all up. The balance sheet is just profoundly resilient.
Very low debt, I noticed.
Almost none. And no liquidity concerns whatsoever. Plus, the cash generation is phenomenal.
Over $14 billion in operating cash flow. Why is that specific number so important for you, the listener?
Because it gives them immense strategic flexibility. It's the ultimate shock absorber. They can take market hits, they can keep investing in global logistics, and they can do it all without needing outside money.
It lets them outlast competitors.
It does. Which brings us to the recent market action. Because despite all these fantastic fundamentals, the Q3 release, it caused some real volatility.
It did. The market reaction was pretty negative, wasn't it?
It was. And this is where expectations meet reality. The financial performance was, as we said, massive. But the market has a hyper-high bar for these companies.
I missed the consensus forecast.
Exactly. Missed on both EPS and revenue. And even though the numbers were great in absolute terms, that miss was all the market needed to see.
It's just so unforgiving. An 87% profit jump, but a slight miss on consensus triggers a stock drop. It shows you how much is already priced in.
It does. But here's the divergence. You look at analysts like Morningstar, and despite that volatility, they actually increased their long-term EBIT forecasts.
Oh, that's interesting.
Yeah. They're looking past the short-term miss and see this inevitable margin expansion coming once the heavy spending on Temu starts to, wind down.
So the structural story is still intact, but we have to talk about the risks that are creating that uncertainty. Execution has to be number one.
Absolutely. The complexity of rolling out into dozens of new markets, each with its own rules, own consumer habits, own logistics. It's an enormous challenge.
And then there's the external stuff you can't control.
The geopolitical factor. You can't ignore it. The U.S.-China tension is this constant cloud hanging over the stock.
Right. Any policy shift, any new restriction, and you could see instant volatility.
And that's a real operational risk. It could force costly changes. Plus, they still need to spend heavily on subsidies to lure users in new markets. That's going to keep pressuring margins for a while.
And one small thing I noticed, on sentiment. There was no significant insider buying reported in 2025.
A small data point, but one that people watch for sure.
So with that in mind, let's look at the technicals. What is the chart actually telling us right now?
The setup is actually surprisingly clean. Despite the noise around Q3, the stock is in a clear, bullish trend over the last 3 months.
Higher highs, higher lows?
Exactly. And it's trading comfortably above both its 50-day and its 200-day moving averages. Those are key support levels.
So the medium-term trend is still up. What about momentum?
Also looks healthy. The RSI, the Relative Strength Index, is sitting between 55 and 65. That tells you there's strong buying interest, but crucially, it's not in that overbought zone.
Okay, so there's still room to run, technically speaking.
It suggests there is. The stock's kind of hovering in that 128 to 136 range. It's really testing resistance near 140.
A clean break above 140 would be a very bullish signal.
Very bullish. And what about the big money? Are the institutions still on board?
It seems like they are, for the most part. Large institutions have generally maintained or even increased their positions.
And the options market.
Leans bullish. The activity there suggests more investors are betting on upside than downside going into the next earnings report. The sentiment from the institutional side seems robust.
Okay, so we've covered the fundamentals, the risks, the technicals. Let's pivot to what's coming next. The confirmed catalysts that will drive the action.
First up has to be the Q4 earnings report, right? Expected late January.
That's the big one. And it's always a seasonally strong quarter for them. It captures Singles Day and the entire holiday shopping season.
If they can show margin improvement on top of big sales, that would be huge.
A major boost. Then before that, around December 15th, we have index rebalancing, MSCI, FTSE.
Why should the listener care about that?
Because it forces huge non-discretionary buying. The big index funds have to adjust their portfolios, which drives a ton of volume into the stock.
Got it. And then in January, we get the 13F filings.
Right. That's our first real look at which major funds bought or sold during the Q3 volatility. It's a huge tell for institutional confidence.
We should probably also mention the auditor change. Ernst & Young Hong Kong took over in July, a move towards more transparency.
A very important administrative shift, yeah.
Okay, so those are the confirmed dates. What about the speculative buzz? The rumors?
The chatter is all about accelerated expansion. Rumors that Temu is going to push harder into Latin America and Europe in Q1 2026.
And historically, those kinds of rumors have often come before official news.
They have. And then there's speculation about a joint venture for global logistics. If they could pull that off, it would be a game changer for their margins.
A major catalyst for long-term investors.
For sure. And with their strong balance sheet, there's always talk about a share buyback program to support the stock price. Or, on the other side, a restructuring of their subsidy programs to focus more on profitability.
Lots of potential moves on the chessboard.
A lot. So if we bring this all together, the huge growth, the execution, the risks, the catalysts. What's the final thesis here?
I think the case is really rooted in that sustained structural growth. They're just so well positioned with their model.
It looks compelling for both short-term traders playing the Q4 earnings and for, long-term investors betting on market leadership.
The critical thing to watch, though, in early 2026 will be that execution. Can they get global logistics right, and can they start to rationalize those massive subsidies?
The core question isn't whether they can grow. I think we know the momentum is there. The real challenge is transitioning from a pure land grab for market share to sustainable long-term profitability.
And can they do all of that while navigating the geopolitical minefield between the US and China? Can those two things coexist for them on a global stage? That's really the question you need to be thinking about as we head towards that Q4 report.